Thank you.
Thank you, Ian. Thank you, Rob. Thank you to all of you who've joined today. I really appreciate your time. Yes, so as Ian said, my name is Emma Davidson. I am the CEO of a company in London called Stoudy Capital. And my husband is the CIO. We have a team out there. We actually have two CIOs, but Miles, my husband, is the main risk taker. And we manage the Australian listed investment company Global Value Fund, or GVF for short. Just a quick intro into GVF so you have that context. We have been going for 10 years. Just celebrated our 10th year anniversary. Very proud of that. Our net investment portfolio returns have annualized at more than 10% per annum. And over that 10-year period, we've had 10 years of consecutive positive performance. So we haven't had a down year. To say that another way, we've run with half the volatility of the MSCI, so global equities. So very chuffed with what we've done. In terms of what shareholders have partook in over that time, because that's really what matters. Either as a shareholder, you have reinvested all your dividends and your 10,000 is worth 25, just over 25,000, or you've taken your 8,000 in dividends and your 10,000 is worth, just under 12,500. So that's GVF. That's who we are. And that gives you a flavor of our ASX listed fund. But we're not here to talk about that. We're here to talk about active versus passive, and the heading, not all investments ideas are in an index. Now, I'm going to be honest, and I'm going to say that this statement probably wasn't obvious to me 6 to 12 months ago. Let me give you a little bit of background of why that is the case. So my background, I initially spent 12 years on London investment banks, trading the passive dream. My role really was to create investment products that were around global indices, so S&P, MSCI, the FTSE, the CAC, whatever it was this passive investment offering that we were doing. After that, I've set up my own company. I continued to sell the passive dream. So the question is, how on earth do you end up as the CEO of an active funds management business? Well, it is a good question, and I think a couple of things. One, I really believed in this strategy, and I've really come to love it. But it is fair for me to say that I've always kind of taken a dimmish view of active funds management. I've been a big believer in passive for a long time. Personally, a lot of my portfolio will be passively invested, but then I'll complement it with really great active fund managers. So, like a hedge fund like Brave and Howard, I would love, or I do have a lot of GVF because I really believe in the strategy. But it's only recently that I've come to understand that the passive world has changed quite dramatically. And actually, I'm coming around to the view that I think more than ever, we need alternative active managers to complement the passive dream. And there's a couple of reasons for that I wanted to share with you today. And Ian mentioned me losing an argument. It's true, I did lose an argument, and I lost it on a public forum on a stage at the Australian Shareholders Association. Miles and I were asked to debate active versus passive. Now, I was fighting for the passive side. Miles was coming in for the active side. And, I'm going to tell you, I'm going to be honest, I came in bullish. I really thought I had some great arguments. I've always been super passionate about the passive industry. I thought that I'd nailed some kind of killer blows there. I used a lot of the SPIVA data as well, the S&P index versus active that's been going for 20 years. That really does illustrate that the majority of active fund managers just don't outperform their indices or their benchmarks. And out of nowhere, Miles came at me with 3 arguments that really floored me, if I'm honest, and that really illustrated to me the point that not all investment ideas are in an index. Yeah, it was a big deal. I will never do my husband's pretty eloquent, well read, he's softly spoken. I'm never going to do him justice in trying to replicate what he said. But what I can do for the purposes of this call is just present to you guys the 3 points that were highlighted to me and which have kind of reframed the way I look at how I invest today. The first thing that Miles pointed out to me, which is obvious, and I'm sure is obvious to many of you, was this idea of crowding in indices. And, I know Australia, you guys have always had, the ASX has always been quite a, mining and bank focused index. But globally, if you look at the S&P or if you look at the MSCI World, probably the most followed index in the world, or any other FTSE, for example, or any other index, you expect to get a very diversified underlying kind of basket of companies. Indeed, the S&P is 500, the top 500 companies in the US. The MSCI World is the top 1,400 companies globally. And when I say those sorts of numbers, for me, in my mind, when I was selling the passive dream, this was a very diversified, low volatility offering that I would be able to talk to my investors about. But what he kind of pointed out to me was how crowded and how concentrated these indices have become. Some of the things that he mentioned were obviously the Magnificent Seven. I mean, I know many of us have probably heard about the Magnificent Seven and read about the Magnificent Seven. But what he pointed out to me was that in 2023, 2/3 of the S&P 500, 2/3 of the returns came from the Magnificent Seven. So 7 companies out of 500 companies produced 24, produced 2/3 of the returns. And that really kind of, those sort of numbers really started to hit home for me. The other thing, I then went away, I looked at the MSCI and I thought, okay, maybe it's not as bad on a global MSCI 1,400 stocks basis. But, it was just as bad. I think, of the 1,400 stocks in the MSCI, the 7 Magnificent Seven make up less than 0.5%, but they were responsible for, more than 20% of the returns last year. So he really drove home that point of crowding and concentration and the fact that, a huge part of your investment portfolio, so that diversified portfolio of stocks that you get via an index, are being driven by a small handful of mega caps. And I think between you and I think I always knew that, and I'd read about it. And before that, we were reading about FANG, and then we were reading about FONG, and there were all the acronyms that these investment bankers come up with. And I kind of knew that the indices were getting more concentrated, but I didn't fully appreciate how much more concentrated. So that was the first point that he brought to me. The second point that he brought to me was the huge shift that has happened in private markets. So, traditionally, as a brand new business, 20 years ago, the only place you would have gone if you wanted to raise money for your company would be to list on a public exchange. Since passive has come in, and this is just a graph to show you, this graph shows the number of listed companies in the US coming to the public markets. And it shows you that period since passive has come in. I mean, passive came in the late 90s, and you can see since passive has come in, the amount of companies that are listing on public capital markets has just plummeted. And that doesn't sound like a lot, 8,000 to 4,000, but over a 30-year period, that compounds massively. And so I was like, oh, wow, are just less companies coming to market? And the answer to that was absolutely not. More companies are coming to market, but of course, they're no longer listing on the exchanges. Why should they? With the regulation, with the scrutiny, with the fact that the passive industry will just copy everything that you do, all these businesses are now going to the private markets. And again, for me, private equity was always like esoteric ideas that, nobody really wanted to put on the public forum. So they kind of went to the private equity markets, and they kind of went that way. But again, my thinking was outdated. That's not the case. You look at the amount of US companies in the US with more than $100 million in revenue. So these are serious companies. These companies have all gone private. So that was the second thing that just blew me away. So first, I thought I had this massively diversified index that I was trading, and I was 20 years ago, but now it's become a much more concentrated, much more, it's just a different index, right? So it's much more crowded, much more concentrated. Two, not only is my index crowded and concentrated, but the amount of companies that are coming into those indices, so the S&P 500, the MSCI 1400, the amount of companies has just massively dwindled because it's all gone to the private space. And then the killer blow for me was what he showed me on the returns. Now, I can send you a very long disclaimer about how I have compared private equity to public equity, because of course they are different beasts. There is leverage, there are things to consider, and I can talk you through how we have compared them. But what I've done here on the chart is I've shown in the blue what private equity markets have done, or the alternative space, if you like, and what the public markets have done. And what you see here as the outlier, hopefully, is that over that 1 year period, the Magnificent Seven have absolutely been magnificent. They have carried public markets to levels that are quite frankly unprecedented. So the 1 year period, you can see there that public markets have outdone private equity. But what you can see for the rest of the chart over 3 year, 5 year, 10 year, 15 year, 20 year is that those private equity space has absolutely killed the public markets in terms of performance. And I think that for me was the killer blow. It was like, wow. So not only do I have this massively concentrated index, I'm not getting the future Microsofts, the future Googles, the Apples, because they are no longer coming into the indices. And I'm not getting access to the performance that happens on the private equity space or the alternative space. Because when I talk about private equity, what I'm really talking about is the alternatives, companies that have gone private. And for me, on a stage in front of many people, I think we probably agreed, he being as charming, my husband is very charming, and he probably saw that I had been pretty flawed by his arguments. And we agreed that actually the best outcome of all of this was that passive, what has been an incredible innovation and has been an amazing, evolving thing that we now have access to, but it more than ever needs to be complemented by the alternative space, by access to products that gives us access to these types of returns. And it also explained a lot more to me. So I don't know about you guys, but for me, I have been in a lot of presentations really recently where the passive industry is selling me more and more products. So it's no longer just access to, the traditional index, the S&P or the FTSE or the MSCI, but it's like thematic ETFs now, and we have sector ETFs. And I kept thinking, wow, this is weird. Why is a passive fund manager kind of selling me a thematic ETF. And a thematic ETF, for those on the line who don't know, it's this idea where a passive investor, a passive provider comes up with a sure thing kind of theme, and then they create a basket around that sure thing theme. And I was trying to get my head around it. And I think what I realized was, initially I was like, this is amazing, this is great, there's even more product for investors to choose from. Now they've got thematic ETFs and they've got equally weighted indices and et cetera, et cetera. But I realized that the drive from the passive industry for that comes from a place of, well, I think it comes from a place of the public market is becoming smaller and smaller. So the way to kind of combat that is to create more and more products, which kind of gives us this feeling that we still have access to a huge amount of investing. But ultimately, to circle back to the heading today, not all investment ideas are in an index. That really has come home for me over the last year or so, and I thought I'd share that with you. Maybe you guys are like, yeah, this is also obvious. Yeah, I knew this all already. But for me, this has been something that I have kind of come across and has been a big awakening for me in terms of making sure that I always combine my love for the passive industry, my love for index investing, with access to really great alternatives that can complement my portfolio.